Coming to you from the Mining Indaba 2014 in Cape Town, we put the spotlight on 2013 trends and the outlook for 2014 when it comes to merger and acquisition activity in the mining sector. Just how keen are financial players in becoming key performers within this space? Joining me for this conversation now is Sandile Hlope. He's head of transaction advisory services for EY Africa. Thanks so much, Sandile, for joining us this afternoon. Well, we've seen 2013 being described as one of deal inertia. We had deal volumes dropping back 25%, value pulling back 16% as well year on year. How did Africa fare within that global context?
Look, I think there was pretty much consistency between global and Africa. So in Africa, we also saw a specific drop in volume as well, around the same region of 20 in terms of volume and in terms of value as well. In total, we had only about 11 deals in Africa. That shows that there was a big slowdown. Compared to prior years, we had slightly more deals, so you're looking at the 50 sort of type number deals. Also, if you pull up the whole Glencore-Extractor merger, the deal levels in Africa were actually much lower. So the continued trend of slowing down inertia in FY13 was present even in emerging markets. That said, though, we are seeing quite an interesting trend in terms of some ray of sunlight in terms of private capital looking to enter into the resources space.
Okay, let's take a look at the state of things as it is before we throw forward. I mean, in most instances, when it comes to the majors, at least the focus has been to repatriate capital back to mature market headquarters to optimize capital and strengthen balance sheets for expansion when the cycle turns. So have we hit the bottom yet? What's your sense of whether that turn is coming sooner rather than later?
I think our view, we hit the bottom of that trend. I mean, if you look at a lot of the global major economies, economic confidence is beginning to return, and you're seeing a lot more focus on saying we've been focusing on cost control, literally repatriating capital on our balance sheets. How do we make a different move? So if you look at in terms of going backwards, you find that there's a key focus around the majors looking to repatriate capital to support growth in future trends and going forward. But in essence, the key interesting fact is that emerging markets being perceived as one common homogeneous type view. There's a trend that there are some low-risk economies in which people can participate. So majors are basically looking at buffering up their balance sheet with a view of doing a bit of a sort of wait out and see. But during that opportunity, you get to see a cyclical investors coming into play. So we are seeing the bottoming out of the huge capital outflows and a change in terms of a bit of capital inflows with cyclical investors.
Give us a sense of capital raising abilities right now.
So capital raising right now are much more pronounced in what we call the private capital investor space. So your private equity funds, our study estimates there's close to about 10 billion US that has been raised for investment in the resources sector over the next 5 to 7 years in Africa, primarily by private equity firms looking for sort of low value entry type levels. We've also seen the interesting phenomenon of development finance institutions beginning to enter that space as well, because generally the likes of your African Development Bank, IDC, DBSA, and institutional investors such as PIC, mainly because a lot of them are beginning to look and saying the resources sector is a big job creator and economic stabilizer. So as we see the flight of capital, of large capital, strategic, we're seeing an entry of DFI capital and a lot more private capital seeking for high growth investment opportunities, especially in low risk countries in Africa.
You highlight some of the social imperative, but of course there's the flip side to consider as well, and where private equity funds have $10 billion in capacity to actually pump into this resource space. What do you see it spelling for risk capital availability for juniors and development projects along the way?
I think so. That's why we're seeing quite a huge deployment of those funds. So primarily a lot of the private capital is looking for deal size values of between 50 to 100 million US. So if you look at that, it means it's your juniors type level. So we're not going to see the large deals of 300-500 million US plus, which you typically see from large majors. So this means a lot of the juniors should position themselves well in terms of having good, strong management teams, a sound growth strategy, and more importantly, a platform that enables multiple geography investment in mining, because a lot of this capital is looking to diversify their risk investment in Africa by being present in more than one country, in one geography. So the strategy becomes build a platform of a couple of countries over a 5 to 7 year period, with a view in 5 to 7 years when the majors begin to return, you can then exit with a good multiple return from that space.
You talk about low risk geographies. Are there leading target commodities that these investors have front of mind?
Yeah, so typically you're looking at areas such as, your copper. We've seen quite a big interest in that. Platinum until recently was having a good run, But typically, if you look at Africa, coal is also a big big driver. With the increased demand of energy in South Africa and other emerging markets, so coal resources are becoming quite favorable. If you look at the deals generally, what's happening in Africa, the front runners were copper, your coal, and in those particular areas.
So when it comes to investors evaluating some of the criteria, to those investment opportunities, low-risk geography stands out as one, target commodities another, but also to leverage off underperforming assets. And with that comes the question around valuations as well. Give us a sense of the price expectations gap or valuation, because one assumes that comes to bear. So what are we looking at in that respect? It surely influences, the financial investors, for example, in becoming particularly active in merger and acquisition activity.
That's very true. So currently, I would say, the current market valuations are more favored to private investors, mainly because there is a huge lack of debt funding and liquidity in the Africa sort of capital market. And as you know, equity funding tends to be the lowest form of borrowing in terms of your sort of long-term outlook. So we are finding that in terms of valuations, that there's a good meeting ground between investors and what the developers are looking to pay for, especially in the junior resources sector, where a lot of projects have been developed over the last 2-3 years, and all they need now is ramp up capital to actually increase output, and that's why we're seeing huge interest from investors.
So juniors versus big boys for capital investments, how are they stacking up against each other?
I think there's a huge appetite for both sides, because what we're seeing the majors doing is actually carving out certain divisions and assets and actually beginning to have and actually sell those. Whereas also the juniors, we're seeing the ones that are bulking up. So the ones who are at the end of their development cycle are the ones which are a lot more being favored. And in that sense, we're finding that the DFIs are helping with the earlier risk pre-development phase and helping get those projects to a bankable stage. So a lot of funding, what we call sort of a BFS, is coming from your DFIs. Sort of post that is more from the private investors. So there's a good match between carved out interest and also looking at juniors that are at the end of their development cycle.
So a lot of optimism that you come to us with. What do you see as being the biggest risks to doing deals in 2014?
The biggest risk definitely continues to be sort of economic and policy outlook. And then also there's quite a number of countries in Africa that still need to have elections the next coming 2 to 3 years. So two things that long-term investors tend to look for: one is political stability, and number two is policy certainty. So in a number of countries, for example, like South Africa, Nigeria, where you've got elections coming up, there's still a bit of a lag in those areas where we're seeing where there has been elections and clear direction forward. Countries, looking at such as Ghana and some of the sort of Eastern Kenya, that's where you're seeing a lot more appetite, and there's now certainty around the government leadership and so on going forward. So some of the key things is to look for, saying, where are we in the political election cycle? Has that passed? Can we have a view that, say, in the next 5 years, there'll be a bit of certainty? And then more definitely, it's, policy formulation clarity around where's it heading.
Sandile, let's leave it there. Thanks so much for having joined us today. Of course, Sandile Hlope is Head of Transaction Advisory Services for EY Africa.